Good afternoon, ladies and gentlemen, and welcome to the STM Group results presentation and update on prospects. To start with, if we could cover a couple of housekeeping items. Before we begin, we would like to submit the following poll, which you will see on your screens. Throughout this presentation, investors will be in listen-only mode. However, questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen, or if anyone has dialed in, via stm@walbrookpr.com. We will endeavour to answer all questions today. However, failing that, the company will review all questions submitted and publish responses where appropriate. These will be available via your Investor Meet Company dashboard. Finally, we would like to remind you that this presentation is being recorded. I would like to now hand you over to Chief Executive Alan Kentish and Chief Financial Officer Therese Niche.
Brilliant. Thank you, Tom. Good afternoon, ladies and gentlemen. Thank you for taking the time to dial in to hear our interim results presentation. I think a good starting point really is just to give a little bit of background in terms of us as a group. In one form or another, we've been around as a private company for best part of 30 years. But here of today, in terms of how we've evolved as a business, basically our core business is administration of client assets, and that really forms two distinct areas. There's basically our pensions businesses and our life assurance wrappers. But either way, it is about the administration of client assets. So in simple terms, a pension administrator. Within our stable of products, we cover both the UK workplace pensions arena, and so we have a master trust there that deals with the employers, etc., and their employees in terms of the state requirements. We also have then a private pension arm, and that really is covered across three areas, three jurisdictions being UK, Gibraltar, and Malta. And within that private pension arena, we look after SASs in the UK, we look after UK SIPs, and we also have basically a division that looks after the expats, which is really the CUROPS arms, and the CUROPS is administered basically in Gibraltar and Malta. In addition to the pension side of things, we have basically two life assurance businesses in Gibraltar. That one of those came about by way of acquisition in 2016. Both those life companies don't take investment risk, they don't take mortality risk. They're there purely to provide basically a portfolio type bond product, and therefore again very similar to a wrapper or a savings structure in a similar environment to that of pensions. To give a bit of background in terms of our strategy, where we are today, there's two very distinct areas in terms of our growth strategy. One is organic, and I'll touch on that shortly, and the other is inorganic. One of those the pillar in terms of inorganic is very much about acquisitions. We have a track record of doing small acquisitions that we are able to be bolt-on and have added to our profitability. In the past, we have taken a number of acquisitions where the business was loss-making and had foresight to see that they would be turning to profit, such as our UK workplace pension that we acquired. However, looking forward, all of our acquisitions will be profit enhancing from immediately upon acquisition. And I've got an acquisition slide a bit later on just to explain a bit more of those parameters. From an organic side of things, we're fortunate as a group that we've got a fair amount of diversity, both from a pension perspective, the fact that we do corporate pensions administration as well as private pension administration, but we've also got, as a differentiator, that we operate in the UK market as well as the expat market. There's not many players out there in terms of pension administration that cover all of those four different quadrants, if you like. As part of this organic growth, though, we need to tap in and enhance and really harness the power some of our partnerships, and that's part of my excitement going forward as to what we've created in terms of looking into 2022. A fundamental thing that we are working on is our ability to really tap into our IT technology. And there's a slide explaining operationally where we got to in terms of 3 or 4 really big projects in terms of that IT strategy. And that will form part of the actual trading update. So as a snapshot, what have we got? We've got around about 280 colleagues within our business, split reasonably evenly. The UK now has become the larger of the hub. As we focus on that growth, that's almost the easy part of the growth strategy. And we've got circa 230,000 clients. That sounds like a big number. A decent chunk of those, something in the region of 180, 190,000 are to do with the auto enrolment. So that's really about the number of employers more than the members. Number of employers are in excess of 5,000 employers that we have on our master trust books. And the remainder then is basically our private pensions side of things. So moving on to the last 6 months, there's a number of things that we've done really in the background, and it's frustrating that they don't yet show through in terms of the numbers, in terms of what we've reported in the first 6 months. A couple of key things really. One is strategically, we have exited 2 of our businesses. We made it known that the trust and company businesses that were actually our legacy businesses where we started off life as STM, they are no longer strategic to us. They've become smaller and smaller in that overall revenue stream, and it's a difficult market to grow, in my opinion. So I was particularly happy that we exited those businesses. I think we got a reasonable price for them. I think they've gone to a decent home, both from a staff perspective and a client perspective. It really allows us as management just to focus on our core strategy, which is the pension administration and our life wrappers. Looking sort of closer to home in terms of operational side of things, we've taken on over the last 12 months 4 pretty significant IT projects, and they fall into two camps. One is that we have, for our private pensions business, our own proprietary platform administration system called BOSS. We acquired that when we acquired the London Colonial business back in 2016 to 2017, and 3 of those 4 projects were about putting our private pensions business onto this platform. As of today, 2 of those 3 have gone live and fully migrated across, and the third one, which is the Malta business, the QOps business in Malta, moving on to the BOSS system, that will occur by the end of October this year. 2 things really happen as a result of that. One is that we become more efficient because our system is more efficient in terms of how we handle things than where we were previously, which was more sort of the phrase everyone used when they used our old system was clunky. So we will see efficiency gains there. We'll see basically software license gains there as well. But the other side of that I think will be the benefit is that as we see that IT becomes more and more a differentiator in the market, where I think we will see gains is the fact that if we are developing out our own system in a certain area, then actually it will benefit 3 of our businesses, because it's not just if we're developing something for the UK market, which is invariably ahead of the QOps market, then we will be able to apply that to the BOSS system for the QOps benefit as well. The other big IT project was moving from our old system in terms of the auto enrolment business. As I said, we've got best part of 180, 190,000 members on there, and migrating that to the new system specifically built for the auto enrolment master trust market, which is ITM. That is much more automated than we were previously with the old system, which had been adapted as a private pension system to cope with auto enrolment. Again, we will see the benefits then both from a software and licensing cost, but also from an efficiency point of view. And this becomes even more important when you look at the dynamics of the master trust market, where our fees per member that we retain as an administrator is £18 per person per year. So it has to be a slick system, and this is going to become more and more of a differentiator in this market. What else is there to say? I guess the other thing really is just as an assurance tick is the acquisition that we did in August 2020 has now been fully integrated. It's delivering the 1.7 million of revenue that we talked about at the time of the acquisition, and it's now that it's integrated is delivering the profitability that we expected from that business. So it demonstrates really that our track record in terms of acquisitions continues. I'll come back to where we are in terms of the renewed focus, the renewed energy in top line growth, because the one area that I do feel we haven't delivered to the extent that certainly as CEO I would have liked to have seen is on our new business growth, and we've changed our operating model to adapt to that, and I'll come back to talk about that a bit later on. So I'll now hand over to Therese to give you the numbers side of it.
Thank you, Alan. In terms of the financial results for the first 6 months, like Alan was saying, it doesn't seem to reflect the hard work that has gone into sort of all the projects and the various activities that have taken place, such as the disposals, and that's reflected in the numbers. In terms of our revenue on a reported and an underlying, those of you who have followed us for a while will know that we normally include these two measures. Underlying being the normal sort of transactions and the ordinary course of business, and we strip out anything that is sort of technical accounting, for instance, accounting adjustments as a result of acquisitions and changing accounting policies for those target companies, those acquired businesses. In terms of revenue, the reported and underlying figures are the same. There's no adjustments to revenue in this period, and you'll see that those are down compared to last year purely as a result of the disposals. So this year we've also included a further measure, which is the underlying revenue from continuing operations, and from there we can see that that's actually gone up from last year. In terms of the profitability, even that measure, underlying profits before other items from continuing operations and PBT, have also gone down, but that's again as a result of the disposals. When we sold the Gibraltar entity, Gibraltar has got a number of companies, a number of subsidiaries, different businesses, and there were a lot of shared resources. For instance, the building, that's sort of one lease, it's a fixed cost, and therefore those costs have had to be absorbed by the rest of the group. We are working towards saving some of those costs. For instance, the office, we're looking to sublease some of that, and therefore there will be recovery of those additional costs that have had to be absorbed, and therefore we expect profit margins to increase later on in the year and into 2022. One of our key critical KPIs is our recurring revenue. That continues to increase, and that's at 88%. There's a further slide along in the presentation where we can see how that is broken down, and again that percentage has increased as a result of the trust companies having been disposed of. In terms of dividends, the board has approved an interim dividend of 0.6p for the first half of the year, and that's a 9% increase on last year. And finally, on this slide, cash and cash equivalents stood at 18.6 million at the period end, and the cash flow that we generated from operating activities is 1.2 million, thereby yet again outstripping PBT. Looking at the breakdown of our revenue, we can see here how the continuing operations is broken down. So pensions now accounts for 76% of our revenue and life assurance 14%. And we can see that the trust and company management, last year's contribution to revenue was 1.6 million and this year's is 0.8 million, hence the decrease in overall reported revenue compared to that increase in continuing operations. In terms of the recurring revenue, as I was saying earlier, that's increased as a percentage of our total revenues. We can see from this slide that our companies and trust management were typically much lower recurring revenues. Half of that income was sort of traditional, chargeable, transactional based fees, and therefore we would never have considered them recurring because obviously they were very much dependent on the amount of activities that clients were generating in the year. Therefore, as we now focus on pensions and life assurance, that recurring revenue will expect to continue to increase as a percentage in line with that pensions and life assurance sort of in the 90s. Looking at the breakdown of our pensions, so this first slide shows the breakdown of member count for the SIPs and SSASs and the QROPs. Again, those of you who have been following us for a while, we know that QROPs are no longer sort of our focus, and therefore that organic growth reflects the conditions of the market and where we are with that product. Still quite pleasing that it's a low attrition rate, so at 6%, there's a relative stickiness to that revenue stream. In terms of the SIP and SAS, so again, that's grown by 322 and the attrition rate on that continues at 6%. So again, fairly sticky business. Looking at the auto enrollment, so our corporate side, we've onboarded circa 30,000 new members in the first half, and that's aligned with last year's numbers as well. In July and August, we've onboarded 17,000, so very much on track to match sort of last year's numbers of an additional 80,000 members. And we can see here as well the increase in revenue purely from organic growth as a result of those increased members. Looking at the breakdown of pensions revenue, so overall a growth of 10% of total revenue. We can see here where the growth is coming from. So partly as a result of the acquisitions, so that group personal pensions and third-party administration of 0.62 million, that came from the Berkeley Burke acquisition that took place in August 2020. So clearly there was no contribution in last year. And auto enrollment, we can see there the organic growth with QROPs, as we would expect, a slight decrease compared to last year as a result of that continuing attrition. In terms of the life assurance business, last year, as a result of the impact on the pandemic and the decrease in base rates and markets, we announced and we made known to the market that the impact on our business was going to be in the region of 400,000, and that's the 200,000 that is coming through on the life assurance business. Compared to last year, the first half of last year. So hence that explains sort of the decrease in life assurance revenue for this year compared to last year. Nonetheless, this still has this revenue stream and this business still has a low attrition rate, 4-5%. So therefore, we expect that longevity of policies to continue to give that predictable revenue stream going forward.
Thanks, Therese. I think it's worth just spending a few minutes in terms of our acquisition strategy. I think probably a good starting point is that in terms of our balance sheet, we currently are very under-leveraged. We've got 1.1 million of bank debt on our balance sheet. We have a facility of 5.5, originally drawing down 1.6. So we have an existing facility headroom of 3.9 million still available to us. There is an argument that, given the size of our balance sheet and the reasonable strength of that balance sheet, that we could look to increase our debt facility as something to possibly accelerate acquisitions opportunities. Looking at what type of acquisitions would be interested in, we did look at a number of QOps books in Malta and Gibraltar. The reality is that they weren't of the quality that we would have liked, and I think we're going to find it more and more difficult, particularly given the uncertainty in the general SIP market and, therefore in the QOps market, in relation to what are the requirements and expectations of basically of an administrator in relation to investments and investment strategy. So that becomes a sort of key criteria for us when we start to look at acquisitions, is the quality of the underlying investment portfolio, etc., to ensure there's no esoteric assets in there that could give us problems in future. Where that really points us to, I think, is very much that in terms of acquisitions, this is going to be basically aimed at the UK market. I think it's fair to say that it's difficult to see many large portfolios of workplace pensions business. That market is settling down. There's still some consolidation, in my view, to come through in that in terms of master trusts, but there's not much out there in terms of free books of business up for grabs. Where I think our focus will pay dividends is on these smaller SIP businesses, the privately owned businesses. Invariably, these SIP businesses also have a SaaS business alongside it. A SaaS book is slightly different in terms of risk profile to a SIP one, in that invariably the members of the SaaS are the directors of the underlying companies, etc., and it also invariably they are the trustees of the SaaS, and therefore the onus and obligations of the trustees sit with the members rather than with us as a provider per se. So what do we look for in terms of this type of book? As I say, invariably privately owned, probably not having the succession planning that they wanted. And I think where we see our sweet spot really, and typically where our acquisitions have been in that region of between 1 and 3 million of revenue. We don't see many of our competitors playing in that market space. I guess the reality for our competitors they are a step change larger than us, and therefore acquiring something with a 1, 2 or 3 million of revenue just doesn't really move the dial to the same extent as it does for us in terms of profitability. One of the criteria we would look for in terms of any integration play is that we would get a minimum of 30% margin post-integration, delivering on our bottom line. So you can imagine an acquisition of 3 million in revenue, we'd expect circa 1 million to land on our bottom line. And that really does significantly change our profitability as a group where we are here and today. So certainly I would see that going forward, we will be able to announce further acquisitions end of 21 going into 22. And it remains absolutely a core pillar of the PLC growth strategy. Summary and outlook. I suppose the starting point is to say that as management, we are trading in line with our expectations in terms of the 21 numbers. I'm very conscious that I haven't yet spoken about our aspirations in terms of revenue growth. One of the fundamental changes to me as CEO is a slight mindset change at PLC level in terms of we need to be more focused about growth. We're a small company on AIM, and our aspirations have to be as growth of revenue, and that's going to drive our profitability. I think we spent probably the last couple of years building our platform, so to speak, in terms of governance, risk appetite, and infrastructure so that we can scale our business. And the expectations from the PLC board now is that we need to focus going forward in terms of revenue on the top line. The starting point in that for me is that the PLC board have agreed that we need to centralise the sales function. Previously, that sat with the various different subsidiaries and the MDs. The reality of that is if you're an MD of a subsidiary, is you're juggling various different balls at the same time. One of those is just running the business. One is dealing with whatever matters are within the happen to land on your desk on that day. And then you've also got this funny thing about growing the revenue line. And by stripping that out and saying, right, this is going to be grabbed by the scruff of the neck and driven by group, I think basically allows us to really accelerate that growth. So I'm really pleased to say that the MD of the UK companies, Christine Hallett, has taken on that role of Central Director of Business Development. She's very experienced in that area. Her energy and her vision is very much about top line growth, and you can see that more in terms of the 50% growth that we had in the corporate pensions business last year in terms of the UK. And with those relationships that he currently has and the ability to spend full time on the top line means that we will accelerate growth. I have no doubt about that. A lot of that strategy in terms of growth is to tap into the distribution that we have with some of our partners. A really good example would be that in the UK, we've partnered with Waheed Invest, who are, they offer the Sharia compliant UK SIP and Sharia compliant workplace pension. That started to really start to pay dividends in terms of that UK relationship. But the reality is we've missed a trick in the past and in the first 6 months, because actually, for using them as an example, the majority of their distribution is not in the UK, but it's actually overseas. And they're keen, for instance, for us to put on our portfolio bond onto their platform, so that we have a Sharia compliant portfolio bond. We will have a Sharia compliant international occupation scheme for their overseas employers that they did work with and deal with. And suddenly that allows us to have another 2-3 different products on the same platform using the same distribution that we currently haven't taken advantage of previously. A similar but alternative example would be a number of independent platforms who have seen their working relationship with a SIP, another SIP, interrupted by this other SIP provider potentially purchasing their own platform, means that we've seen a number of opportunities for basically white labeling a SIP for these platforms. And whilst this is sort of the lower end of the market in terms of the type of bespoke, it's not so much bespoke in terms of SIP, it will give us volume. There's absolutely no doubt about it. So you start to talk about an additional 1,000 SIPs per year from this particular platform, or 1,000 SIPs from that particular platform. So a lot of our revenue generating opportunities are not necessarily us having to build some huge infrastructure. It's actually tapping into our partners and working hand in hand with our partners. I hasten to add that that's not to say that we don't look after our existing intermediaries. Clearly, that's an important part of our bread and butter in terms of our organic growth. But I think I see that these strategic partnerships as giving us that next level of growth. So that really is exciting for me. I think as part of that, what we'll see generally in the marketplace is that we will be using the options brand. That was well received in terms of the UK market. We'll be using that for our rollout, again, for international products, etc. And I guess sort of the final part of the equation as we move into the end of 2021 will be ensuring that we've completed all our IT projects. So by the time we hit the ground running in 2022, not only are we seeing a top line growth moving forward, but actually we're seeing that our IT operating systems, delivering the improved margins that we would also like to see. In terms of investment case, I continue to think that we're undervalued. I think there's some really strong themes about recurring revenue there that give us a base as we open the doors on January the 1st, etc., to know that we've got this revenue coming in, and it's now about accelerating the additional revenue. We've got that scale, we've got the new IT systems in place. So again, it's about putting in top line revenue without having to proportionally increase our costs. And I think that's probably
Right.
me finished, Tom, in terms of
Okay.
overall.
All right. Well, look, thank you, Alan. Thank you, Therese. If we could now turn to the questions. We have a number of questions that were submitted ahead of the presentation. However, please do continue to submit your questions using the Q&A tab situated on the top right-hand corner of your screen. I'd like to remind you that a recording of this presentation, along with a copy of the slides and published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. Additionally, your feedback is important to the company, so immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback. While you're submitting questions, let us first have a look at those submitted ahead of the event. We've got a couple actually which are in and around the topic of acquisitions, and I'm going to group together, Alan, if I can, because you have touched on the subject already and answered some of the direct questions, but let me group these together. The first one is, do you have an active acquisition pipeline? Second one is, what does an ideal target acquisition look like? And you have articulated that a little bit already. But also, Ryan has asked, what is the M&A landscape looking like pricing wise, and which areas are you looking to build on? And maybe the colour that might be really helpful here is to look at vendor expectations and just give us a sense of what you're seeing in the acquisition market itself.
Yeah, thank you. Yeah, good questions. From an acquisition point of view, we have someone who is based full-time with STM. He's been part of the furniture for quite a while here in STM, but prior to that, he was with PwC in terms of their corporate finance division. So he is M&A through and through. I think the reality is, for the last few months, or certainly for the first 4 months of this year, he's been diverted. Rather than looking to buy stuff, he's been ensuring that we've had a smooth transaction when we've sold the 2 trust and company businesses. So there has been that distraction in the first 6 months. Where we get to today is that there are a number of interesting acquisitions for us in terms of information memorandums that we're working with. So I think it's fair to say, yes, there is an active pipeline in terms of where we stand. And I think that goes hand in hand with the observations about potentially increasing our credit line in terms of that acquisition slide that we spoke about, just as a flag. The pricing's an interesting one, because I've sort of got a mental block about paying some of the prices that go out in the market, and I don't think as a small business we can justify it and recoup in terms of paying a PE 10, 12 times. And actually, I don't think we need to. I think the area that we're focusing on is that 1 to 3 million of revenue, and invariably we're looking at somewhere between 1 and 2 times revenue. To equate that to what we would expect, that's probably a 5-6 year payback. I think it's fair to say the last acquisition we did was the Barclay Burke, and that's probably going to land at about 2.3 million for 1.7 million of revenue, and we would expect that to generate somewhere in the region of after integration, 500,000 or so of PBT contribution. So it's that 5-year payback scenario. And there are businesses out there, and there's businesses that want, because it is very much relationship driven, and these are family owned businesses. I think we fit a model where we take people on, we look after their staff, rather than necessarily just being a fairly aggressive consolidator. And clearly there are some of those in the market as they stand. So yes, I do see that there's opportunities at decent prices for us. And again, it's going to be that UK focus.
Great. Okay, that's very helpful. So Therese, probably one for you here. Great to see such a high percentage of revenue being recurring. Do you see this increasing, and already recognised in brackets, amazing levels already?
Thanks, Tom. As we focus more sort of on pensions and life assurance, as we could see on that slide, the recurring revenue levels for those revenue streams are sort of low 90s. Life assurance, in fact, was at 98. So clearly, as we focus more on pensions and life assurance, we should expect to see that 88% of recurring revenue to sort of get closer to the percentages that the pensions and the life assurance revenue streams are showing. So probably in the low 90s. So yes, I do expect those to increase slightly over the next sort of 6 to 18 months. Most of our products don't have an establishment fee and are actually fixed fees. So that's what's driving that percentage of recurring revenue.
And I think it is a common theme of our business in terms of the products and the administration structure that we have. It just goes hand in hand with that, that annuity revenue over whatever the 15, 20, 25 year lifespan. And if you look at a good example, I suppose, the average age of our CureOps book is something in the region of 53. And so all things being equal, providing people don't fall off their perch too soon, then we've got them for another 20 plus years. And I think that's a common theme, but you could also argue that it's a theme within our competitors and the marketplace generally.
Yeah, great. Okay. Now I've got a question here, and you have in large part answered it, but I was just going to hopefully angle it slightly differently. But the question is, how will your new role of Group Director of Business Development Strategy improve your new business rate? And you have touched on this in terms of the centralisation, but I wondered if you might be able to add a little bit of colour in terms of the broader market themes around new business, and I think particularly of opportunities that might necessarily have been slightly held up by COVID and Brexit, and whether you're seeing any change in how that environment is freeing up or not, given where we find ourselves today.
Thanks, Tom. I think it's a really interesting question. My gut feel is that some of the decision-making process has slowed down as a result of COVID. But it is actually very easy just to continue to use COVID as an excuse for growth. I think what we're seeing at the moment is almost a mental change, and I think I certainly saw that at our PLC level, is to get back on the front foot. And the partners that we're working with and talking with, and I had a number of meetings with some strategic partners last week, and everyone is back on the front foot about let's get this done. Whereas I think, certainly a year ago, there was this uncertainty around there. So I think we'll see some of these deals close quicker now than previously. Putting that onto Christine's shoulders, which takes a bit of weight off my shoulders, is that she's absolutely got that energy there. And the bit that we were missing as STM, it seems really simple at the time, but it's a reality, is that we didn't have that centralized, and therefore when we had individuals talking to different partners and to different intermediaries, we were potentially just showcasing one of our products rather than saying, well, actually, if you've got distribution for your SIP, have you thought about distribution, for using our workplace pension, for instance, as a good example? And it's simple things like that. Or if you've got distribution in the UK, do you also have distribution overseas? Because yes, if you do, then we have products that would suit you for your overseas market. And so the the ability to grow organically doesn't change with the smaller intermediaries, because we get a steady flow of that. But the step change comes where we have the ability to tap into someone else's distribution, and actually they themselves can give us 500,000 of new business revenue. And if we've got 4, 5, 6 of those on the go at a time, then that becomes a bit of a game changer in terms of our growth strategy. Does that sort of cover off?
Yeah, that's some good colour. That's very helpful. Okay, so one more question, and I'm equally just going to sort of put this in some degree of context as well. So we've talked about acquisitions, we've talked about how STM might act as a consolidator, but obviously there's a food chain out there somewhere. And James T has said, do you think STM might be a target for takeover? If so, who might bid? Now, I guess there's an element of sensitivity around that, so please don't go any further than you feel appropriate. But I guess there is a broader consolidation theme to that.
Yeah, I think where we stand today as a small micro cap AIM quoted stock that hasn't necessarily done as much as, or hasn't delivered, certainly in the face of it in terms of PBT, as much as we could have done over the last 18 months. I do think there is always going to be that vulnerability. I guess the phrase "everything's for sale at the right price" is something that I'm very conscious of as a CEO, as a shareholder, but also the institutions that support us. So I do think we're undervalued. I think there's massive opportunities for growth, and I think as a PLC board, we believe that we need to deliver that growth to really enhance shareholder value. Who would look to target us? I guess we're a reasonable sized business for one of the larger pension administrators to take us over, or potentially a financial services group that is possibly more of an intermediary, and they're looking to actually have that product provider in place as well. If you look at sort of the models that you see out there, such as SJP, etc., where there's been that vertical integration in the financial service market, I think that will continue. By the way, and using us as an example, when we acquired Barclay Burke, we acquired a small employee benefit consultancy company as well, so that we can offer additional products through the auto enrollment, for instance. So there is going to be vertical integration within the financial services market. So that would potentially leave us as a target for someone who needs product rather than distribution. So I guess there's always that threat or challenge, I guess.
Yeah. Okay. Well, look, I mean, as I say, it's a big food chain out there. But thank you, Alan. Thank you, Therese. I think that sets the scene very nicely for the next 6 to 12 months. Could I ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide your feedback. If anyone has further questions or would like additional information on STM, please do get in contact via stm@walbrookpr.com. But thank you for the presentation. Thank you all for attending, and we look forward to updating again soon.
Thank you very much indeed, everyone. Thank you.